Hey, Steve Saretsky here. As always, Canadian real estate market update with a particular focus on Vancouver. If you get sort of value and entertainment out of these videos, all I ask you hit thumbs up and subscribe. Questions, comments, put those below. As I mentioned in my last week's video, that I would be doing sort of a holiday Ask Me Anything Q&A hangout session, whatever you have it. So we're going to do that Sunday, January 3rd at 6 p.m. Pacific time. Basically just do about an hour long YouTube live. So come back here on Sunday at 6 p.m. We're basically just going to do Q&A on whatever you want to ask me really regarding financial markets. Obviously real estate will be the main topic of discussion. So mark that in your calendars. But I wanted to frame this week's video on sort of a 2021 forecast for the Canadian housing market. Obviously we're, as I'm filming this, it's January 1st. I think we can all agree it's been a very difficult year to forecast. Certainly myself, I was in the camp that, back in April as the pandemic was unraveling here, that it would be a tough year for the Canadian housing market, that I was in the belief that real estate sales and values would fall. Obviously that hasn't been the case. It's actually been the exact opposite, which really goes to show you that forecasts, for one, are very difficult to make, particularly because the goalposts are always moving. The facts and the data are always changing, and that's why I've always been of the view that, as John Maynard Keynes once said, when the facts change, I change my mind. What do you do? And that's always been the view, right? I mean, like if the facts start to change, that should start to change, your views or your opinions. I think where the people make the biggest mistakes is they become married to one singular outcome, that regardless as the data and the facts start to change, they remain married to that view. And that's certainly not something that I am, because I think the more and more I study, a lot of the smart investors in the world, is that their thoughts and their views on various asset classes are always changing as the data changes, right? I mean, for example, the people that were bearish, Bitcoin back in 2017 in that speculative mania, and then, it collapsed. A lot of those people that were bearish then are now bullish prior to this recent run-up, right? So the facts are always changing, your investment theses are always changing. But, because one of the things I wanted to highlight first and foremost is I kind of want to start off this conversation with the CMHC housing forecast, right? So everybody, looked at that and says, wow, this is Canada's, mortgage agency. They obviously have a better read on the conditions or the shape of the mortgage books than anyone else. They have a vested interest really to say that good things are going to happen to the market. And when they came out and put their, bearish forecast out there, which again at the time I said, well, that's probably a reasonable forecast. I actually don't think it's over the top at all. So I'm just going to read you their snippet that they put out in this report back in May. It says, Canada will experience a historic recession in 2020 with significant declines in all housing indicators. Sales are likely to register a decline in the range of 19% to 29% from their pre-COVID levels before beginning a slow, gradual recovery in 2021. Our forecasts indicate that sales are not likely to recover to pre-COVID-19 levels by the end of the forecast horizon. Our forecasts indicate that the average MLS price will decline by 9 to 18% from its pre-COVID-19 level. Prices will begin to recover in the first half of 2021. Again, this is CMHC, your government agency, with all their hired economists, with all the data that they have on their mortgage books. Not only did sales not fall nationally, we will hit a new record high this year. So you'll have the most ever, the highest number of national sales ever for any given year in 2020. And not only that, but not only did the price not drop by 9 to 18%, the average sales price, at least as of the most recent recording here in November, the average sales price across the nation was up 18%. So it didn't decline 18%. It actually went up 18%. So again, when the facts change, you have to change your opinion. So anyone that's still married or stuck to CMHC's forecast back in May, I think has clearly missed the boat. Now, again, when we talk about the facts have changed and sort of my view here moving forward into 2021, the facts changed when the government came out and decided to run a $450 billion deficit, and the Bank of Canada essentially, not officially, decided to monetize that debt by running massive quantitative easing programs. These programs are designed to boost asset prices, and they're designed to raise the value of real estate prices. So I always have to laugh when politicians come out and say, oh, we care so much again about housing affordability, it's the worst thing ever. Yet you're running monetary policy with its core objective is to drive financial values or financial asset prices higher. So again, as someone that is a market participant or someone that has to advise my clients, it becomes very difficult to advise them to try to run counterintuitive to what policymakers are trying to create their outcome objectives. The outcome objective is to raise the asset prices, so raise the value of real estate. Again, not that I agree with a policy like that. So I think looking forward into 2021, the key things that we were looking back at the beginning of 2020 as this pandemic was unfolding was the mortgage deferral cliff. It was people not being able to pay their mortgages. It was the financial distress. And what we've actually seen is between all these fiscal monetary programs, it's actually been the opposite, where households, at least the vast majority of them, are actually better off today. They're sitting in larger cash piles today. And so we take a look at, this is a great chart from my good friend, Ben Rabideau. Now, Ben runs, for those of you who don't know, Ben runs a newsletter subscription. He actually advises financial institutions, hedge funds in the US, Canada, etc. He advises them on the Canadian economy, the macro landscape, particularly housing. And Ben's actually had more of a bearish tilt on housing, particularly during the onset of the pandemic. And he was highlighting on social media, and we've had these discussions internally as well, is that this mortgage deferral cliff has essentially become this nothing burger, where these deferrals are basically rolling off, people are resuming payments, and it was really just people panicked and automatically went into these deferral modes. And again, through these massive monetary and fiscal stimulus supports, they've been able to basically offset and provide incomes to these households. And that was the key risk. And the secondary key risk was financial institutions, particularly the banks, would tighten credit. It was naturally assumed, and this is typically what happens during downturns and credit cycles, is that banks will tighten credit at the moment of adversity. But again, because you had this health crisis, it basically prompted policymakers to bring in measures where they had sort of the political cover to bring in these programs, which they basically told the banks, to some form of forward guidance, that you need to lend money. We cannot have a contraction in the economy. We cannot have our housing sector go down. This is a pandemic. We must do whatever we need to do to basically bail out that segment of the economy. And so what the banks have done is they've actually increased their credit creation. So what you can see is residential mortgage credit growth. The latest figure as of September, but I can assure you that number is going to continue to accelerate higher, is you've seen the exact opposite. You've actually seen banks almost loosen up and extend more credit. And so, again, when we look at what were the key risks at the onset of the pandemic, the key risk was tightening of credit, people not being able to pay those mortgages, and you would normally see the first signs of that stress would come from the secondary or the shadow banking system. So for example, the mortgage investment corporations, these MICs, you would see it in the private lending space. These people would see the initial pain, you'd see the initial defaults, because for example, while commercial banks like RBC and CIBC gave people 6-month mortgage deferrals, private lenders and MICs don't have the financial ability to do that. So a lot of them were doing 1 month, maybe 2 month deferrals for people that needed them. And so these would be the first sort of corporations, private corporations, that would see the first wave of defaults. And again, it's actually pretty much been the opposite of that, is what we're seeing, again, anecdotally, what I'm seeing on the ground when I talk to these companies, when I talk to people in the industry, is you're actually seeing the reverse. So the pipeline of foreclosures is actually very dry right now. In fact, a lot of the mortgage investment corporations, these private lenders, are actually having difficulties. They're having difficulties placing new capital. So basically what's happening is a lot of people, there doesn't seem to be a demand for these instruments, for these private instruments. People are actually going to the banks. They're going to the banks to get money, and the banks are actually lending the money. So there's no real demand for secondary high interest rate mortgages. So this is completely counterintuitive to what we were thinking at the beginning. And so that's really what's driving my thesis moving forward. Is I don't just have a view where this is what I want to happen, or this is what's the best desired outcome for me as an individual. I just look at the data and the anecdotes and say, okay, this is what's happening. If the biggest risks, which were households defaulting because they can't pay their mortgages, and banks tightening credit, that is what drives housing downturns. When banks tighten credit, that is what drives housing downturns. And so if the opposite is happening and banks are actually loosening credit, then that creates the exact opposite outcome. And that's why you have, contrary to CMHC's forecast, you have sales up and prices up. So the data changes, I will change my mind. And so if the data changes in 2021 at some point, and the banks decide to all of a sudden, change their view on issuing new mortgages, and if policymakers decide to bring in various policy moves to slow housing, or the Bank of Canada somehow has a come to Jesus moment and decides to hike interest rates, then I will change my view, because you should change your view if that happens. And so that's kind of how I'm looking at things moving into 2021. I think the momentum is on our side. In fact, Canadians look to agree. If you look at the Bloomberg Nano survey, sentiment has never been this bullish on housing since 2017. And so I think we're running into a scenario where you could have the momentum start to build on that. And again, this is the directive of policymakers now. Actually, to sort of end things off here, I want to point you in the direction of a clip. For what I do is I actually will take the time to sit down and watch an hour-long interview in the House of Commons between the Bank of Canada's Tiff Macklem and our policymakers, and see what the dialogues are happening, see what they're discussing. So if I can bring you any sort of value entertainment, it will be dissecting an hour-long video and saying, okay, what are the policymakers doing? What are they talking about? What is likely to happen next? And so I want to take you this clip now here of everything that I've kind of summarized is exactly what policymakers are doing today. So the thoughts of the Bank of Canada's QE programs, what it does, and what are the likely outcomes now moving forward here in 2021. So let's clip to that video right now.
Let's move on now to the QE program, which is the massive purchase of government securities by the central bank. You said a moment ago that your bank actually sells these securities to the marketplace and then buys them right back from the same investors to whom you sold them. What is to stop an investor from profiting off the difference between the price of a government bond or treasury that you sell them and the price that you pay to buy them right back?
Well, these are both of these are done in competitive auctions. The auctions are heavily oversubscribed. There's lots of bidders on both sides. So it's a competitive process.
Right.
And I think that should give you some assurance that
I have no doubt it's competitive, but you've stated that the purpose of quantitative easing is to drive up bond prices. And so presumably you're paying more for the bond after you've increased its price through your actions than you sold it for. And the difference is profit to the investor that bought them from you and sold them back. And ultimately, that cost has to fall on somebody's shoulders. Who actually pays that price?
Well, as I said, it's a competitive process. Yes, we are exactly as you indicated. The way quantitative easing works is by buying the bonds. That creates more demand, which pushes up the price and lowers the yield. And that is how we're delivering monetary policy, lowering the cost of borrowing for Canadians.
Right.
That's what it's doing.
But you're pumping $400 billion into financial markets, inflating financial assets and enriching the people who own those assets, who are overwhelmingly affluent and well-to-do people. And in the process, you are diluting the wages of working class people. Your own policy paper from your bank shows that inflationary costs are borne disproportionately by the poor and the disadvantaged. So you're effectively transferring an enormous sum of wealth to those who have financial assets while diluting the wages of working class people. Are you not worried that this is going to expand the gap between rich and poor?
So let me unpack. There's a couple parts of that question. So let me unpack it. First of all, I agree with you entirely that inflation is borne disproportionately by less wealthy people. They tend to operate more in cash, and so they tend to disproportionately bear the cost of inflation. And that's exactly why, that's an important reason why the mandate of the Bank of Canada is to maintain low, stable, and predictable inflation. That's something we can do for society. Right now, inflation is actually too low. It's below our 2% target. It was 0.7 in October. There's, as you're well aware, over 600,000 Canadians are unemployed. There's a lot of downward pressure on inflation. We're more worried about it going even lower, which can be harmful for other reasons.
Thank you.
So the Bank of Canada, as I've said from the onset, these guys admit exactly what their policies are designed to do. The policy is designed to raise and boost asset prices. This is creating wealth inequality for people that own assets, stocks, real estate, gold, etc., boosting asset prices, and it creates, again, a wealth divide. Now, they had the opportunity, they had the option, policymakers had the option back in March and April when markets were crashing. They had the option to step back, to let markets reset. So again, values of Canadian real estate were extremely high. Everybody can admit that at the onset of 2020. They had the option to let it ride and let values decline precipitously. Instead, they decided to go the opposite route, which is we're going to devalue the currency. We're going to print money and we're going to support the value of financial assets in the hope that we will stem some sort of recovery out of that. That is the option and the route that they decided to go down, right? So you have to understand that these policies and what they mean. So again, at the onset of the pandemic, we didn't necessarily know that these policies would work. Would they be effective? How much would they do? So you need to understand, you need to watch these policies. And so moving forward, if they're going to continue to tell me that they're going to continue these programs which raise asset prices and drive inequality, it is very hard and to me it doesn't make sense for me to try to fight that. And so my personal view is that while I do believe that the momentum is on the Canadian real estate side, for example, and on asset prices in general, moving forward in 2021, because of a currency devaluation, I still believe, I guess I would say my bearish view in some instances to sort of counter this is that I do believe that policymakers on the fiscal side, so the federal government, the municipal governments, the provincial governments, are going to come after real estate increasingly hard moving forward. They're going to try to create more taxation against real estate. I think that will put a lid, in my opinion, that will put a lid on how much real estate values will be allowed to increase. I think they'll continue to raise taxes on real estate. I think that they will begin designing programs because there's going to be so much political social and political backlash that they're going to have to design and create programs to try to reverse some of these inequalities that are being driven by monetary policy. So these programs could be, they're going to incentivize more first-time home buyer programs to get these young millennials into the market because they're being priced out by these programs, these monetary programs. So you're gonna have to create some fiscal programs to help first-time buyers get in the market, while they might try to counteract some of the investment or speculation in the market. So again, the government's already talked about a national foreign buyers tax. I could see them bringing in various lending programs that will try to curb or slow or disincentivize people from investing in real estate. So people that own, they're going to try to get, I think they could design programs where they will try to disincentivize people from owning, 3 or 4 or 5 condos. They're going to try to limit that kind of behavior, and they're going to try to spur people on the lower end of the scale to get into the market. And that is my opinion on sort of moving forward here in 2021, and moving forward is what their programs that they're going to do. So that's kind of my outlook for the new year. Again, obviously, I'm curious to hear your thoughts. I think that's the whole point of this channel, is to have that dialogue. But I think moving forward, it is pretty obvious what policymakers are going to do. They're very, very easy to read. And I think as the data changes, your opinions should always change. So hope that video helped. If it did, thumbs up, subscribe. We'll see you next week.